Chris Harvey of Wells Fargo, right here at Post 9. Welcome back.
Thank you.
Well, that's a big setup for you, man.
It's a big setup.
7,007, not 7,000 and not 7,005, 7,007.
Big James Bond fan. It's 7007, just so you know.
All right, 7007. Why'd you come up with that and how?
Well, we came up with that. The market multiple is 22. We saw 16% growth for next year and the year after that. That's matching what we expect the S&P to do next year. And so really we're not talking about multiple expansion. We're talking about EPS growth and EPS growth going higher. You have a good economy. You have tight credit spreads. You have less regulation. Fundamentals are improving. And the rich continue to get richer.
So this is all based, if not, maybe not all, but substantially based on what people expect to be a Trump policy bump for the market.
Yeah.
That's what it sounds like.
It's that. It's the fact that you have a strong economy. Credit is widely available. M&A is going to come back next year. IPOs are going to come back. The title of our report was Good Year, Bad Vintage. We think markets will go higher, but this is the year where people go too far out on the risk curve, too far down the capital structure, and systemic risk goes higher. But while that's occurring, equity markets usually go up while people are taking on more and more risk.
Wait, so let's rewind for a second.
All right.
Systemic risk goes higher.
Yeah.
In what sense? There's just too much risk taking. There's too much euphoria.
Yeah.
Through where do you see that most acute?
So
you think?
We're starting to see valuations or leverage multiples go higher. We're starting to see people move further out on the risk curve. For the last year and a half, people have made a lot of money buying strength and selling weakness. Momentum, as you've talked about in the show, very strong factor and continues to be. And when you do that, you continue to push your bets and push your bets. So this is an environment where people will continue to take on more risk. Because why? We're also going into a period where there's less regulation, where I think the economy is stronger. And furthermore, I think the market's getting healthier. With less regulation, you should have a broadening out of the market. You should have better breadth. And for a while, I think people are going to make a fair amount of money. Just you have to be careful toward the end of the year, because when we look back at 25 from perhaps the perch of 26, 27, we're going to say that was a year that people got too aggressive with risk.
So you think the market goes even higher than your target, but then towards the end of the year, it sort of has a moment where it pulls back to get to where you think?
That's possible, right? We could have a bit of euphoria. I'm not really sure how it plays out. We think that 7,000 is a pretty good target.
Better not be 2,700.
But if you go back to 2019, you go back to 1995, 2 years where you had tight credit spreads, you had the Fed easing, we had much higher returns than we have at 16%. Or the expected 16%.
Okay, so it sounds to me you want equal weight, right?
Yep.
You play for the broadening,
Yep.
play the big game,
Yep.
right? And you don't necessarily want to go all large cap.
Right.
Under your scenario, small cap, mid cap?
Mid cap, I'd say. Not so much small cap. Small cap still is just not a great risk reward. It's more of a broadening out, an equal weight. So S&P equal weight should make sense. Mid-cap growth, as I've talked about many times, still makes sense. And we like the barbell between banks, communications, and staples.
I mean, that's pretty concentrated breakdown of what you want to do, right? I mean, 40, 40, 20.
Yeah.
Banks, comms, services, and then staples.
It's worked pretty well
so
for us.
concentrated?
Well, you know, we've set up a barbell for many years. For the last 2 years, we've had a barbell. It's been communication and defensives. Mm-hmm. This year, we've broadened it out to more cyclicals. On the defensive side, we like staples. Staples are really unloved, underappreciated. We think the fundamentals are turning, right? But we want exposure to banks and financials. We love that space. We think there's a real revaluation. There's been a big revaluation.
Well, that's the thing. The's been a big, right?
There
so
has, and it's
we...
going to continue. You don't change 15 years of upward regulatory pressure in 15 weeks. You're going to have more multiple expansion. You're going to have positive EPS growth. Capital markets are going to improve. It's going to be really positive for the group. Not a straight line higher, but it's going to be really positive.
So like when I look, I've said this already, when I say Goldman Sachs up 56% year to date, JP Morgan up 44%.
Right.
You're like, yeah, but. I mean, that's just getting started?
That's just getting started. We've had a very difficult environment for M&A activity. What goes with M&A activity? IPOs. What goes with IPOs? Trading activity. So we're not there yet. Furthermore, as you start to deregulate, as the banks need less capital, there's more capital available, there's more risk-taking, more opportunity. So we don't think it's over. We think it's just beginning to get started. And the other thing to think about is the momentum trade. The face of the momentum trade is now financials. If you look at the MTUM, the momentum ETF, one of the biggest, if not the biggest sector right now is financials. That wasn't true a year ago. A year ago, 40% of it was tech. Now, tech is something like 20%. So it is broadening out.